Thanks to all of you for coming out to learn a little bit more about what we're doing. I see some familiar faces here, some friends, and for those of you that we haven't met yet, I look forward to chatting with you after the presentations over a glass of wine or a glass of champagne. We've got 30 minutes. So the old adage of Benjamin Franklin, time is money, so we'll try and stick to the script here and get going. Bradley Hall. I'm the chairman and founder of Icon Capital Reserve. I grew up in Canada, and I've been working in tech and finance for 32 years. I often get asked, what exactly is an entrepreneur? And I guess the short answer is you try and figure out which way the trend is going, get out in front of the herd, and wait for the rest of the world to catch up. So for those of you who have not met with me yet, I'd like to share with you a little bit more about my background. One of the first companies I got involved with out of school had some very cool vectoring technology, mainframe based, and of course you can tell by the great hair, I went to school quite some time ago. So this was before GPS satellites. We had figured out how to identify a location and then deliver services to that location. Our goal was to create an online Yellow Pages, and unfortunately 32 years nobody cared about online Yellow Pages, so we had to pivot, as you often do in technology. And we were able to obtain live feeds from the stock exchanges in New York and Toronto. This is the first time that you could get real-time trading data for non-professionals. And that company ultimately went public. I then connected with some gentlemen who were English, who had developed software that allowed you to write software without being a programmer. You could actually create software. Being a non-technical person, you could write 25 lines of what was called then C code. And the English entrepreneurs were quite bullish on selling the software to everyone in the world. We thought there might be a better approach, and our approach was to set up a software factory where, because of the compelling advantage we had in the reduced time to code, we could offer firm price and firm delivery dates. It was the first software factory that was established in North America. We ended up exiting that business to an Indian firm who used the platform to go on and create outsourcing in India. At the time, it seemed like a spectacular deal. That company's gone on to become worth about $80 billion. I took cash. I kind of wish I had taken some stock. But for a young guy, it worked out okay. I spent some time at IBM helping them to move OS/2 into the market. They were competing head-to-head with Microsoft, who was also supplying software to them. And in a very short period of time, we were able to bring in 6 million new customers and about $1 billion in new revenue for them. I was also able to learn very quickly that I could never work in a large bureaucratic environment, so I decided to stick with the entrepreneur thing. What came next was a Canadian structured products fund. We took Canadian tax credits, which had been around for years as sort of incentives that they have now in many countries that allow you to invest in smaller emerging companies. And we packaged them and put them in a fund and brought in the top fund manager in the country. We got our approvals relatively late in the cycle because it was tax driven. We only had 25 selling days for the fund, and I ended up bringing in 25,000 investors in 25 days. Our first pass brought in 128 million, and the fund went on to manage 1.8 billion when it was sold. And this is 22 years ago, still stands as a record in Canada. Of course, if you're the owner of a fund with a couple of buddies that's throwing off 6% a year, the next thing you do is move to Barbados, which I did, and worked on my best Captain Morgan impression for several months before getting back to work and setting up a merchant bank. The merchant bank was called Icon Capital, and the investment thesis was really that what was happening in software, where we were seeing business processes getting automated, would ultimately allow for a convergence of telecommunications and, at the end of the cycle, probably finance, which would all converge into ones and zeros. And it was on that basis I moved to San Francisco to invest in technology. And I arrived there in 1996, right in the middle of the go-go days of .com, which actually reminds me a lot of what's going on with ICOs, and I'm going to talk a little bit more about that later. But it was a free money era, And although a lot of the companies that ended up going public ultimately went away, there were some juggernauts that were created at that time as well. If you think of the eBays, if you think of Amazon, if you think of Google, these are all companies that were created during that era. When things blew up in San Francisco, many of us headed to the golf course or to the mountains. For me, that was up in Whistler, where I had a home, and spent a disproportionate amount of time skiing and having fun. I looked around at all my friends in the bar most nights and all my alcoholic friends and said, I'm too young for this. I need to go back to work. And so I had reached out to a colleague who was the president of Oracle Software in California. Oracle themselves were a very acquisitive software company. They had made a complete mess of their software and services around the world. So we partnered with them and ended up buying companies in places like Russia, Azerbaijan, Kazakhstan, Ukraine, throughout Eastern Europe. In the Americas, of course, the US, but also places like Panama, Venezuela, Colombia, down to Argentina, and also throughout Asia. It was at this time we had done the roll-up very successfully, and we were taking that company public. And I remember the date. It was August 7th of 2007. Some of you might remember that. It was when a French bank called BNP Paribas announced to the world that they didn't know how to mark their derivative investment book. And overnight lending stopped that day. For me, it was quite visceral. It was like getting hit in the middle of the chest with a spear as I watched hundreds of millions of dollars effectively go. But it also led me down the rabbit hole. And I began to understand how gold underpins the world's financial system, how the strongest intergenerational dynasties in the world denominate their wealth in gold, how the sovereigns of the world denominate their foreign exchange in gold. And it was on this basis that we set up a physical gold trading company in Hong Kong. Of course, gold is a very opaque business. It's a very challenging business. And our goal was to actually perform a little bit of reverse alchemy. And that reverse alchemy was to take physical gold and convert it into ones and zeros that could be traded and moved around the world easily. And that became the genesis for what we're doing at ICON. ICON Capital Reserve was established in 2013, and if anybody's been following the blockchain, that is like being 100 years old in blockchain years. Our goal was to empower private clients to create, trade, and reserve value with gold in the blockchain. So those of you who've experienced an ICO or initial coin offering or have been hearing about them or reading about them, typically they're launched by a couple of guys in a pickup truck who have a cool idea and they draft a white paper and wait for the millions to come in. Now, this one's a little bit different. It was launched by a couple of guys in a McLaren. Now, there's a lot of skepticism, and I can tell you that when I was traveling around speaking with audiences like this, family offices, ultra-high net worth investors, all over Asia, all over Europe, throughout the Gulf, people would typically look at me like I had just beamed down from the Enterprise, like I'd come from another planet. They were talking about blockchain, gold. What are you talking about? I mean, this is 2013, 2014, 2015, 2016. All of a sudden, things started to pivot. And if you look back, here's a headline from The Sun, a British paper. This is from 1991, talking about the worldwide what? The computer web to change billions of lives? Yeah, right. Well, it did change billions of lives. In fact, it created billions of dollars for early investors. Mark Andreessen took some technology that was originally developed in the UK by Tim Berners-Lee, and he created a little company called Netscape. And Netscape's mandate was to create essentially on-ramps onto the internet, where this so-called super highway of information was available. They exited Netscape relatively quickly for about $12 billion, as I recall. There were a couple of grad students at Stanford and in around my old stomping grounds, so Larry Page and Sergey Brin, who launched Google. And their mandate at Google was to index the Internet of Information. What a lot of people may not be aware of is in the late 90s, when I was living there, Google and Brin were trying to sell, or Brin and his partner Page were trying to sell Google. And they were working through Vinod Khosla, who at that time was at a prominent venture firm, Kleiner Perkins, and they approached George Bell, who was the CEO of Excite. You may recall at the time all the rage was around portals. And they offered Google to George for $1 million, and he declined. Through Vinod, They got the offer down to 750,000, and George Bell also declined. And I guess lucky for Sergey and Larry, they stuck with it because the company's now worth about $640 billion. So if you're looking at ICOs, initial coin offerings, and you're looking at CCOs, which is a term we've dubbed, which is collateralized coin offerings, it's true they're creating fortunes for blockchain investors. And it reminds me a lot of the IPOs in the mid-90s, late 90s, early 2000. The difference is the protocols have changed. So whereas on the left you'll see the original internet is that you had a protocol layer, and the protocol layer HTTP is what drove the internet. And the internet was basically free. Anybody could tap into it. All the money was created on the application layer. And so this is where the Googles of the world made their money, where they created their companies, was in the application layer. Now what's happened with the blockchain is that this has been completely inverted. So the protocol layer is now something we call a FAT protocol. And this is what your ICOs are. You have initial coin offerings where companies are trying to establish a value protocol. They're trying to establish coins that you'll need to use to utilize the blockchain. And this is the difference. And you know what? Some of them are going to prevail. Now, for our company, we've looked at this and we're highly skeptical of, the circa 2,000 ICO tokens that have been created. But the reality is, in the last 2 years, there's been 10 billion in capital allocated to this space, and it's now an investment sector worth 400 billion. So this is starting to sound a little bit like real money. And I can tell you it's serious and it's happening. I can tell you with certainty that 99% of the ICOs that are done will fail, but I can tell you that the 1% are going to dominate future money going forward. Now, I'm not a technical guy, so I'm not going to spend a lot of time this evening getting into too much of the guts of what's going on in the blockchain. If you understand these three key attributes, you know everything you need to know about the blockchain. So the first is that the software runs on hundreds of millions of computers around the world. It's like a supercomputer. And the important takeaway is that there's no single point of technology failure. It just runs. The second is it's not owned by anybody. It's open source protocols, which means that you can't have Google or Facebook or any of these companies change their algorithms on a whim. It also means that it's very difficult for the ABC agencies to get backdoor data, which they get from all the big software companies. So the blockchain can't be co-opted or manipulated. And the third, for the same reason as there's no single point of technology failure, you have a distributed ledger, which means that there's no single point of regulatory capture. This is not about being evasive. This is simply about being competitive. It means that information and value and money will flow to anywhere in the world where it's accepted. Even here in the UK, my fellow Canuck, Mark Carney, head of the Bank of England, has acknowledged that the blockchain removes centralized failure risks. Now, the second part of that would be where does a central bank sit in a distributed, decentralized architecture? Not sure. I guess we can ask Mark. Now, many confuse Bitcoin with the blockchain. They're synonymous. You hear in the articles. The Barron's here is talking about how Bitcoin is the future of money, storming Wall Street. Bitcoin is a ledger entry on a distributed network. Bitcoin and Ether have both validated that the power of the blockchain is there, but they collectively act like a claim check with nothing to claim. So if you've looked at these tokens skeptically and said, where is the beef? I don't get it, you're right. There's nothing there. However, they have provided that same sort of speculation opportunity that drove IPOs, that drove technology in the 90s. And because early adopters have to have a chance at a reward. Otherwise, technology never gets adopted. And the rewards have to be disproportionate. So early adopters of new technology will take high risks in a high reward area, knowing full well that most of these will go away. Bitcoin, I know many advocates of Bitcoin. Many of the guys have been in since the early days, and they continually tell me that Bitcoin is math-based money. And I continually tell them, yeah, that's true. But the math doesn't work. You've got an entire industry or asset class that is correlated. That means that every token that's out there has spawned from the original Bitcoin protocol. Ether, everything is correlated, which means when it's drafting upwards, as we've seen for 2 years, it takes most of these with them. But when it does revert to the mean, which it will, the whole thing will collapse. The early adoption, again, has been driven by speculation and, of course, anonymity. And the next phase, the phase where we go from 400 billion in assets to trillions in assets, will be when we solve for the technical limitations and address value with trusted assets. And that's what we're doing. We started 5 years ago on an original colored coin protocol on the original blockchain. We found challenges scaling, and we've abandoned that. We've now switched to Ethereum, smart contracts, where you can actually process transactions. Now, once you start talking about virtual money, once you start talking about anything that has anything to do with value, you have to start to figure out how to convey trust. And as a smart entrepreneur, I try and surround myself with the smartest, most trustworthy people I can find. And we're lucky here tonight that 2 of them are actually with us. The first is Marcus Grubb. And Marcus, you want to raise your hand? Right here. Marcus, some of you who follow precious metals and gold will recognize him from his appearances on MSNBC in the US frequently, on the media here in the UK, in Japan, in China. Was the MD of investments for the World Gold Council, so helped them commercialize gold-structured products all over the world. And Marcus and I are fortunate to, we met 10 years ago, and Marcus has been helping out with strategy and positioning and getting us ready for a scalable gold money business. George is also here. George, you want to raise your hand? George is a prominent bankers consigliere. He is the CEO of the Arab Bankers Association, and so is wired into financial institutions across the Gulf and the Middle East, and a trusted advisor, and has been extremely helpful to us with ideas, with introductions. And we're lucky to have him. We have a couple of other, Bob Flores in New York, former assistant dean at Princeton, is partner at McKinsey, was a partner at McKinsey, has helped many of the Tier 1 bank CEOs get their jobs, quite candidly, and has advised many of them. And we have Ali, who's based in Singapore, also Canadian. He's a governor of the University of Toronto and has launched a digital currency exchange in India. And so has some interesting insights into different locales. Now, when you're in the business of creating trust, trust requires context. Gold is universal. So you see the Union Jack there, and it may generate a response. You may feel good about that. If you're a tennis fan, you probably feel real good about it. If you're a golfer, you go, yeah, I remember that. Gold medal, Rio, Brazil. If you're in Berlin or Brussels, maybe not so much. Psychologists have determined that we can't distinguish between watching events and participating in them. So we tend to identify with these trusted contextual icons. And as you'll note from any competition anywhere in the world, the best of the best usually get gold. They get gold medals because gold is universal for value. Embedding trust also requires other carriers. And in the universe we live in, there's something called Fibonacci's golden mean. It's a mathematical formula that permeates everything from our atomic design to the stars. Many of the most iconic buildings, the pyramids, the Sydney Opera House, even the National Gallery here in London, since the dawn of humanity, these sacred geometric designs actually are embedded with carrier waves. So when you go into a place of worship, you go into a church or a temple, you feel good. Part of that is based on the design of the building that's transmitting information to you. That's something we've taken on board at ICON. We've used sacred geometry to help design the symbols of value that we've created. We have a Sintamani, which in Sanskrit is turning thought energy into gold. It's based on the same golden mean. We have AUREALS, which together are gold and money, and the tricerta that we use fits actually inside a Sintamani, and that's fungibility in a geometric, trusted way. And of course, the flower of life utilizes the golden mean as well. If you look back at how money is created as we have, and I mentioned we spent some time down the rabbit hole, we went back as far as Babylon. And we were able to uncover a system that was designed where they're embedding trust using assets to create money. They were led by a king who came up with 282 laws, and they started accounting, ledgers, banking, money. When Aristotle studied the Babylonian banking system, he discovered that every object was an asset and offered utility value. So you could have water to sustain you, but you could also store water and trade it. And they developed a semiotic structure that allowed them to eliminate the problem of coincidence of wants. So if you had silk and I had silver, and you wanted silver, I wanted silk, we could do a deal. But if you wanted grain and I wanted something else, we were blocked. In semiotic structures used in Babylon, you put a physical asset and you stored it in a safe place. You create a financial asset, usually a receipt for that asset. And then you create a financial liability, which is a subset of that financial asset that can be traded and exchanged. And it's accepted because people understand that at the end of the day, there's something real behind it. The Bank of England used this exact same structure when it was created. The Federal Reserve used this exact same structure, a little variation of it. They added the IRS and T-bills, but ultimately the thesis was the same. Now, the reason gold has been a default as a heuristic asset is that trust is actually a neurobiological activity of our human brain. And we frame our relationships on a belief of honesty and fairness, benevolence. And when you get into increasingly complex transactions, the challenge is you can't evaluate every option. So you may default to a gut check, to what feels good, what feels intuitive. And gold is a trusted reserve asset for 6,000 years because across history, culture, and language, people trust it. It triggers that neurobiological feeling of, yeah, this is the right thing to do. There's another mathematical reason for it. And again, without getting too much into this whole Fibonacci thing, the stock of gold refers to the available 185,000 metric tons that have been mined through history. 2,700 metric tons are mined every year. So that's got a stock and flow ratio, a mathematical ratio of 1.4%. The stock of our planet, if we can refer to humanity that way, is 7.45 billion. The flow is about 80 million new inhabitants every year. So you've got a stock and flow ratio of 1.2%. So as people move up through Maslow's hierarchy of needs and they take care of their basic requirements and ultimately create surpluses, they want to denominate those surpluses in something that people recognize as having value. And we see that in real estate, we see that in art, and we see that everywhere in the world in gold. When you use a symbol of value that loses its value, as every currency in history has, hyperinflation sets in and it's destroyed. In 1919 actually, in Weimar, Germany, economic powerhouse. It took 170 German marks to buy 1 ounce of gold. Well, once inflation set in, by 1923, it took 87 trillion to buy that same ounce of gold. We saw the conflicts primarily in Europe. Nobody trusted anybody, so there was said, hey, let's go back to the system. We'll use gold, we'll create financial assets, we'll create financial liabilities. This continued until 1971 when the US defaulted on gold. Nixon closed the gold window. And in 1973, when the US dollar was coming to the end of its natural life, they cut a deal with Saudi Arabia, with the king, where the Americans agreed to provide military free-flowing oil, and the Saudis agreed to clear and settle oil trades in dollars. And thus the petrodollar was born. John Exeter, who was the head economist at the Federal Reserve, said, we're in a world of irredeemable paper money, a state of affairs unprecedented in history. So we're coming to the end of that cycle. It's been 45 years. They typically run 30 to 40 years. Claudio Borro, who's the Bank for International Settlements, says, confidence in central banks' healing powers has probably for the first time been faltering. Policymakers would do well to take notice. Bob Michel, Chief Investment Officer at one of the largest banks in the world, said, I think Yellen, this is a few months ago, has to look at the capital base being wiped off of the banks. So you think about that statement coming from the Chief Investment Officer at a bank. People have more confidence in gold than in bank deposits or paper money. I don't know if any of you have seen an American show called Mr. Robot. It's about hacker culture, and it's actually a lot of fun. And this is a quote I just lifted out. One of the characters says, "If you give a man a gun, he can rob a bank. If you give a man a bank, he can rob the world." There is some truth to that. What we see listed are some of the new statutes and laws that have been enacted recently. My favorite is in 2014, the G20 approved the adequacy of loss-absorbing capacity of global systemically important banks, prioritizing derivatives payments to each other and statutory bail-ins. That means that derivatives are now prioritized over deposits, and this is a law. It's not the end of the world. The Chinese have a word for crisis, Weiji, and it means opportunity or danger. Whether you see this as a crisis or an opportunity depends on your perspective, your normalcy bias. If you live next door to the volcano and it explodes 50 times, yeah, eventually you're going to be laying there by the volcano. Now, what I'd like to focus on now for the last few minutes is collateralized coin offerings of AUREALS. And AUREALS, again, as I mentioned, are gold money. AUREALS represent a fusion of gold and the blockchain that insulates holders from currency, institutional, and systemic hazard. The ICON Value Exchange platform was initially built on the colored coin protocol of the blockchain and is now launching AUREALS as smart contracts on Ethereum. So this is how ICON creates physical gold money. We start with a reserve in vaults, if you can think of places like Shanghai, Hong Kong, Singapore, Dubai, and Switzerland, where our partners operate a former military facility inside a mountain with a private airstrip. That's where we store the gold. ICON's not a bank. So all the gold that we store is exempt from declaration under FATCA, under various European regulations. This means that when we hold an asset, we can ensure privacy. The Sintamani is created through what's called an SKR, or a safekeeping receipt. A safekeeping receipt has all of the bar identifiers, the weight and measure, the hallmarks, everything that's included on that bar stamp to verify the assay, the weight, and the purity. And they're not securities. They've not been deemed to be securities anywhere in the world. So we take these SKRs and we convert them to smart contracts. And we reserve the smart contracts on the blockchain so they can be verified by anybody in seconds. And you now have converted a physical gold asset to a financial gold asset. They're fully reserved, and all the reps and warranties and rights and privileges are embedded into the smart contract, and you can actually dispute them to the High Court in London if you want. Sintamani are the financial reserve. AUREALS are created based on that reserve. So AUREALS are financial liabilities. Each one is a 1 gram weight and measure of gold. They circulate like money, going back to the Federal Reserve, Bank of England, Babylon. You store your AUREALS in a digital wallet. So if you think of the wallet as being analogous to an online dashboard, you can view your AUREALS, you can send them to anybody else with a digital wallet. We'll clear and settle those transactions in 15 seconds, irrevocably, all without going through a bank. They can also be exchanged for Sintamani, so you can claim the underlying gold or you can convert to any currency you choose. If you're looking at how I illustrated earlier, these economic cycles tend to ebb and flow, where we go 30 to 40 years, where we rehypothecate debt up to an apex and it collapses. Whenever we start over with gold. And this has been measured by Dr. Edwin Vieira at Harvard. Of the 775 sort of fiat symbols that we call money, almost 600 are gone. And Voltaire mentioned all paper money eventually returns to its intrinsic value, which is zero. The Federal Reserve Chairman, who used to print Fed Reserve notes at no cost of production, said the Federal Reserve era of quantitative easing and zero interest rate policies cannot be exited without some significant market event that will result in gold prices moving measurably higher. So this is how we create money. This is how we create earnings. Of course, we can buy gold, and we buy gold bullion all over the world at a small discount. We can transfer the AUREAL value to credit cards and to any currency you choose. We do that for an FX rate. We can transfer to physical gold. We charge an FX rate that is approximately the same as the 40-year return on gold. And We're also engaged in a number of structured opportunities. We're talking to, yesterday there was a meeting in Beijing between the agriculture minister in Brazil and his counterpart about pricing Brazilian soy in AUREALS for international trade. And we're looking at private label opportunities with the platform. Our template for growth is parabolic, and this is something that Marcus's organization has been involved in. The GLD ETF was launched in 2004, 115 million in assets, structured offering, exchange traded. Within a year, it got up to 3.5 billion, 2 years, 8.3 billion, and ultimately 76 billion. So when you have a structured offering that the market is ready for and it resonates, you can create magic. We have AUREALS. This year we'll issue 500. We've already got commitments of a little over 100 million for our CCO. Next year we'll be at 5 billion. We expect to accelerate through 12 billion and up to 100 billion near term. Gold should be 10% of your portfolio. It should be digital gold is the most efficient, but at the very minimum you should have physical gold. And the bond king, Jeffrey here has said that this was at an investment conference 2 weeks ago where he was giving his thesis on most important investments. We see a massive base building in gold, massive. It's a 4-year, 5-year base in gold. If we break above this resistance line, one can expect gold to go up by 1,000 or more. And we see that as coming, as being imminent. Today, out of the FT, in the digital currency space, one of the largest Chinese miners invested in a company in Boston who does currency exchange, digital currency exchange. It was a $110 million round, valuing the company at $3 billion. So again, this is maturing and turning into a serious business. So this is what we're now making available to thoughtful professional investors, private investors. We are offering AUREALS, a collateralized coin offering. We're doing it in the form of a convertible note that has a 5% yield, which is 15% annualized, 120 days. After, at any time that you hold the note, you can convert to AUREALS and you can capture a discount to gold. For the event here, we've doubled the discount, so a 1% discount turns into 2. And if you hold it to maturity, 120 days, you end up with a 7% net discount for a currency based on gold that's sitting in a vault. It's about as good as it gets. For larger tickets, you can, we've doubled the discount again. Again, on maturity, if you convert, you could get a 9% discount to spot gold. And in this circumstance, for those acquiring 500,000 to 999,000, you also have effectively a call on ICON equity. So if you want to participate in the cap table, you have a chance to enter the cap table at a 20% discount. Finally, for $1 million plus, you can of course convert to AUREALS at any time. The promotional discount is up to 6%. The conversion discount at maturity is 11%, and you can convert at any time to equity as well at a 25% discount. So I'd be happy to discuss that with you if you're interested. We've got some time after the presentations are over, and be happy to answer any questions you may have. I'll leave you with a final thought. For 6,000 years, gold has been a trusted reserve of value and the only form of money that has survived. As the command and control hierarchy central bank experiment comes to an end, ask yourself, if the pounds and the BTC symbols I'm holding are not indexed to an asset, what exactly am I holding on to? Thank you very much for your attention.